So today we're going to look at all the important cost factors when it comes to ETFs versus mutual funds. And I remember when I was younger, I would not think about costs at all. And I thought I knew best. And I still remember like it was yesterday. It was just full of pride, full of ego, thinking that I knew everything until I find out that costs were eating into my investment returns because capital gain taxes, fees, all of that affects your return. So nowadays, costs is my biggest priority because I don't want to continue being the same sucker that I was 5 years ago, 10 years ago. So there are 6 factors that we really need to look out for with respect to costs. Now, the first factor is expense ratios. With ETFs, they generally have the lowest expense ratio to small investors. Mutual funds, on the other hand, have various mutual funds that have much higher fees. Vanguard's an exception, but you have to do your research. The second trading cost is that for ETFs, the pro is that they trade in brokerages. The con is that they have bid-ask spreads, which means that it can potentially cause you to lose money, to lose fees, but it can be negligible if you focus on quality ETFs that most people buy and hold. Mutual funds, on the other hand, if you buy it at the originating firm, they usually have no trading costs. Third factor is trading frequency. With ETFs, you can trade at any time during the day instantaneously. Mutual funds, on the other hand, you have to buy them at the end of the day. But the great thing is that some mutual funds have restricting purchases for 30 days after the sale. This is also we can avoid capital gains costs that is distributed amongst holders. The fourth factor is that with ETFs, they distribute less capital gains than the mutual fund equivalent. Whereas for mutual funds, they rarely eliminate capital gains. Capital gains is a result from rebalancing. When you have changes in the index that you're tracking, you need to rebalance, and those capital gains from the selling and the buying causes tax events. The exception is Vanguard's index funds. They are just as tax efficient as ETFs. Also, index funds generally have very low turnover, which limits the problem. The fifth factor is trading mechanics. Now, one of the things about ETFs is that it's hard to dollar cost average into with market orders because of bid-ask spread. Unless you use dollar cost arc, which defeats this problem, we find you the best price and set the limit orders for you. Mutual funds, on the other hand, it's easy. You can automatically dollar cost average without costs. The last factor is derivatives. Now, ETFs can utilize derivatives to boost returns, but will have higher expense ratios when they do this. Mutual funds, on the other hand, with index mutual funds, they only track the index, but this will keep the costs low. I really think that there is one thing that investors don't think too much about, and that is the cost of owning an ETF versus a mutual fund. They really think about whether these costs can cost them thousands down the road. And it's funny because I was thinking about this the other day. You know, men spend the most time researching about a car before they actually make the decision to buy it. I remember when I went to buy my Hyundai Accent, I went ahead and I researched the maintenance costs, the insurance, the miles per gallon to see how much I would have to pay before I actually went ahead and make my purchase. And it's the same thing that I did with this camera that I'm filming with right now. I compared it to many other different cameras, compared the batteries that I need to buy, the accessories, the headphones, the mic. All of these are costs that I factored in before I actually went ahead and bought the camera. But when it came to investing in ETFs or mutual funds, I just went ahead and looked at the expense ratio, make sure it's an expense ratio I liked, and then I just threw money at it without considering the real ownership costs. So the best thing about ETFs is that they can trade at a premium or a discount of net asset value or real value to the underlying portfolio that they hold. That's volatility. That is where we can snap up good deals and get good discounts and then later sell at a high. We can also use dollar cost arc in order to find deals when it comes to mutual funds, but it's going to be harder because mutual funds don't trade on brokerages. And on top of that, another thing about mutual funds is that they're actively managed, which means that there's going to be a person behind the computer trying to make trades in order to beat the market. Now, personally, I have a huge distrust for actively managed because it is usually coupled with high costs and subpar performance. The exception of that is with Vanguard, because Vanguard is known for keeping things low cost, but you know, I'm a biased guy, so that's a biased opinion. And you know, this all stems from my past financial advisors, all of whom I fired, because what I found out back then is that they were all profiting off me for merely helping me set up my account. So basically they encouraged me to start this account with, let's say, Betterment, and I start the account, and then I later find out that they were taking 1% of fees for doing nothing, not giving me any guidance, not checking up with me or anything like that. So I have a very big distrust with Actively Managed. And when it comes to Actively Managed, the game here for them is to try to grow their portfolio, try to grow the assets under management, because that equates to more fees. So there's more of an incentive for these managers to actually do a lot more marketing than managing, because it's easier to get more money marketing, which adds up to their bottom line of their take home in fees. So as I was writing this script for this video, I thought that for sure mutual funds would be the winner in this comparison. But after doing the comparisons and the summary, it's really hard to say no to ETFs, because for the small time investors, the benefits of ETFs are just too big. The only problem with ETFs is the dollar cost averaging problem, which I solved with the dollar cost ARC platform that I created that you can use for free. You can check it out in the pinned comment or the description below. Now, if you're curious about how to dollar cost average into the mega dips, or what I call the bottoms, then check out this video here.